Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about our outlook for inflation and also discuss the geopolitical condition in Russia and Ukraine. For that, we have Leah Bennett and Scott Bernard joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Equity. Scott is a fixed income portfolio manager on our multi-asset team. Hi, Leanne, Scott, how are you all doing?
Hi, Maria. Thank you so much. We're looking forward to this conversation.
Yes, hello. Very happy to be here.
Thank you. So let's get the conversation going. Scott, let's start with you. So will you please recap for our clients the patterns that we have seen in inflation since the pandemic started, and how has the monetary and fiscal policies impacted the prices as well?
Yes, certainly. Thank you. It's been a bit of a wild ride in inflation. If we think back to the beginning of the pandemic, the concerns were really more about deflation, and we were seeing deflationary forces as global economies shut down and in reaction to COVID in March of 2020. We did, and then just recapping inflation on its own. Then coming in throughout 2020, it was really quite low. At the beginning of 2021, we actually came in with a CPI print in January 2021 of 1.4%. This rose to 4.2% in April of 2021. And if you recall, a lot of the commentary at this point was focusing on base effects and how we were having some of the 2020 pandemic really low readings roll off. And there was a belief that this was going to quickly subside in 2021. That clearly has not happened. The most recent CPI print at the end of that just came out, which was for January, was 7.5%, which was 40-year highs in CPI. And in regards to the monetary and fiscal policy, there's been a number of things that have taken place. The monetary policy, and as soon as COVID hit, you may recall, the Fed dropped interest rates to zero and enacted on some very large scale string of asset purchases. Not only did they resurrect the purchasing of treasuries and mortgage-backed securities, but this time they also started buying corporate bonds and municipal bonds using funds that were allocated from the CARES Act. As we've transitioned throughout the pandemic, we've had interest rates remain at zero. The asset purchase program is just now ending. So when the Fed has been talking about tapering, what they were talking about is reducing the amount of bonds, treasuries, and mortgage-backed securities that they were purchasing. They are just now ending that. And although now they're still reinvesting the proceeds, so they're not yet letting the size of the balance sheet shrink. The Fed balance sheet has risen to just about $9 trillion. When in March of 2020, this was around 4 trillion. So it's more than doubled in the last 2 years, as the Fed has been a massive buyer of really treasuries and mortgages. On the fiscal side of things, we had a string of acts. We had the CARES Act that was enacted in March of 2020, which was $2.3 trillion. And this included $1,200 stimulus checks as well as $500 checks for dependents. Then we had a couple bills right back to back at the end of 2020 and then at the very beginning in March of 21. These two combined injected another 2.7 trillion into the economy, with the December Act including $600 stimulus checks, and then the March 2021 Act including another $1,400 stimulus checks. And so really we had the confluence of these two, this injection of liquidity into the market directly to the consumer in the case of fiscal policy, and then we had this dramatic shift towards goods consumption and away from services. So a very simple example of that would be no longer going to the gym but buying a Peloton, something like along those lines, where there's a massive shift in consumption patterns, and these two combined have created basically too much money chasing after too little goods. And so we've seen, the result being these 7.5% CPI prints with, if I look at my Bloomberg terminal, the expectations are that next week we'll get something around 7.8% for the most recent reading. So we have seen a massive increase in inflation, and obviously it's very top of mind. That recaps that. I think we're going to go into some of the other Fed topics shortly.
Yes, super helpful. So I think the more important question is, of course, the headline number, as you mentioned, in January was about 7.5, a 40-year record high. So where do we go from here? What is your outlook for inflation going forward? And it's a question for both of you.
So I think it's quite likely that we see a number of these bottlenecks ease to the extent that we're talking about goods inflation. We've seen a rapid increase in inventories, and those are going to have to run off as as all the container ships are offloaded and the cargo is finally unloaded. On the other hand, we have seen some of the what I would call stickier parts of CPI, such as owner's equivalent rent, and then we're seeing some wage inflation as well. This is kind of the transition back to services. Those are perhaps going to be a little bit stickier. My gut is that we do see the headline number come down pretty significantly, especially throughout the second half of the year. Now there are some real wild cards with regards to Ukraine and Russia, which we'll get onto in a little bit. But I think these, ultimately, I think the Fed really regrets ever introducing the term transitory into the environment. But ultimately, we will get there. It's just that the timeline is significantly longer than I think anyone anticipated when Jerome Powell first started using that word about a year and a half ago.
I agree, especially with your latter point about transitory in the Fed, because I think the Ukraine-Russia conflict probably even further elongates whatever this period is that we're in with these major supply chain disruptions. And I know there's constantly a debate: is the Fed behind the curve? And I think it's really hard to say. And a lot of this is circular. Some of these issues that are coming up. So if you use home builders, for example, a lot of home builders pulled back on building more homes because lumber prices were so expensive, as well as other input prices. And by pulling back on homes, there was less supply, which created an imbalance on demand for homes, and housing prices went up even more. And so a lot of people are just waiting for a correction in prices or a normalization in prices. So I don't know. I think we could live in this environment for quite a while, but I do kind of try to reconcile with the major pull through that we've had with technological development and or the adoption of technology. And I think your point is correct about goods versus services. And coming out of this, we might be moving even more to a service-based economy. I mean, you see, there's a lot of debate about shopping centers, which consumers are interacting with in a different way, where people are doing online shopping. Even a lot of people who would not have done online shopping before have developed a new pattern in that way. And so there's a lot of discussion about shopping centers possibly converting over to industrial space. And I know Amazon is exploring a service where they will actually go into your home when you order groceries and put the groceries in your refrigerator. And so there's a need for the industrial space and the consumer space to be even closer to the end consumer. So I think, we've talked a lot about what things are going to look like as we emerge a couple years out of this period. And I think that's kind of the debate versus where we are now. And then the other thing I always try to think about is the fourth quarter of 18, when the Fed raised rates one too many times, and we had the big correction in the market. So the Fed has kind of a slippery, it has a narrow beam in which it can act, and it's just a difficult period to try to figure out what that roadmap looks like.
Thank you, super helpful. So if you think about where we are in history, we are coming out of a pandemic. inflation numbers across the globe are significantly higher than where they were when the pandemic started. And then on top of it, you add the geopolitical uncertainty with Russia and Ukraine. So how are you monitoring if you're wrong? Because this is such an unprecedented time. Nobody really has a playbook. And how are you hedging your positions if the outcome is not what you're expecting?
Yeah, I think those are great questions, and I think you always do. We talk about a key part of our of how we look at investing is really risk management, and so that kind of gets to your point of how do you try to figure out if you're wrong. And I'm constantly looking at management commentary, spot commodity prices, the credit markets, which Scott can elaborate on a little bit, to try to get cues as far as what is the direction, and is your thought process incorrect, or are you getting cues as to what trends are actually occurring? And I think there's a few ways to look at hedging your position. Again, if you're thinking that inflation is not going to run rampant, then you've got to hedge yourself for that potential trend to emerge. And so if you think about inflation really becoming a major issue, then you've got to think about companies that can pass through pricing increases. And so if you think about companies that have higher margins, it could be tech companies, it's companies that really have nice moats and good business models. Commodities is certainly a way to hedge that. And then if you think about equities in general, despite what's going on in the as far as inflation is concerned, and with wage inflation, which is a big issue, there's been a lot of resilience with the S&P 500 forward profit margins. They've been running around 13% despite this year, despite rising labor and material costs, and that's quite impressive. So it's interesting to see these kind of rotations that are happening in the market, but overall, you're seeing corporate margins hold up pretty well.
So Scott, a question for you. So what do you think the bond market is implying about the inflation expectations for 2023?
Great, yeah. So within the bond market, we do have a pretty good tool for looking at inflation expectations, and this really comes from the Treasury Inflation Protected Securities Market, otherwise known as the TIPS market. So these bonds, their par amount is adjusted for inflation readings, and therefore we can look at the yields of the TIPS, compare those to traditional or nominal treasuries to get an estimate, or referred to as break-even inflation. And you can do this then over different time horizons, depending on the maturity of the which TIPS bond you're looking at. And so we actually saw, when we came in at the end of 2020, from 2 years all the way out to 30 years, break-even inflations were right around 2%. We saw this start to move, and throughout 2021 we saw all of them move higher, but we saw the front end, 0 to 2 year inflation expectations rise the most, and 10 to 30 year longer term expectations remain somewhat anchored. So by the end of 2021, we had 2 year expectations were around 3.25%, and 10 and 30 year were right around 2.4%. Initially, to start this year, we actually saw inflation expectations come down. So as we saw market participants begin to quickly reassess how the Fed was going to react, and we saw rate hike expectations get pulled forwards and in a much more aggressive manner, we saw inflation expectations start to come down. Now, this has quickly reversed itself with the Russia-Ukraine situation. Now that we have a potential source for some real commodity price pressures, we've actually seen 2 year break-even inflation. So that would encompass all of 22 and 23. Those are now above 4%. And this is the first time they've been above 4% since the TIPS market was introduced, and for about 20 years. So that's been a real change in the last week. As this Russia-Ukraine situation has unfolded. Now, that said, the longer term inflation expectations, the 5, 10, 30 year, those haven't moved all that much. So the market is still anticipating that the Fed is going to get this under control, and inflation expectations do remain somewhat anchored.
Thank you so much, Scott. So let's turn our attention to Russia and Ukraine. I don't think a lot of us were, when the year started, were thinking of this crisis as driving market returns. So how has your outlook changed, and how do you think the market's outlooks have changed since over the last couple of weeks?
Yeah, certainly. I think it certainly introduced some new risks. One of the primary, especially on the inflation front, is with commodity price inflation. So Russia's a major supplier of natural gas to Europe, and they're the second largest oil exporter in the world behind Saudi Arabia. There are other areas that don't get quite as much headlines, but they're very important. Some of the metals products like palladium and titanium, which are two key components for semiconductors. And then Ukraine, I'm seeing this more and more, hearing them as the breadbasket of Europe and as a major supplier of grain, which could lead to some more food inflation as well. So, in the micro, I might think, okay, these seem like problems for Europe, more so than the U.S. But given the global nature of the commodity markets, we're certainly seeing the U.S. inflation expectations rise, right along with European inflation expectations. Now, this is where it does put the Fed in a bit of a bind right now. I think it increases the difficulty for them to thread this needle. So on one hand, they're concerned about inflation. That's potentially going to have a few more headwinds. On the other hand, they don't want to hike right in the face of slower economic growth, similar to 2018, as Leah was talking about earlier. So this does introduce some new risks, and I think immediately this means the likelihood of a 50 basis point hike in March is, and it's only 2 weeks away at this point, is quite low. At one point within the last month, the market was actually putting a higher chance of 50% than 25 basis points. If you just look at the futures market, you can kind of get an estimate for rate hike expectations. This has now come down to where it's a virtual lock that they're going to hike for the first time in March. Very unlikely that they're going to go for a 50 basis point hike right out of the gates. For the year, the futures market is still looking for a total of 6 hikes throughout the 2022, putting the Fed funds rate at 1.5% at the end of the year. This has also come down a little bit since Ukraine. We were as high as 1.75, so maybe one rate hike has come out of the market. I'm a little surprised we haven't seen more come out of the market. I think that I think this makes it a little bit more difficult for the Fed to be quite as aggressive, especially if we get continued sell-offs in risk markets, and some of the uncertainty especially in the bank funding market, which we'll touch on in a little bit. But with these sanctions and the SWIFT ban, there are some possibilities that we'll see some funding market stress, which I think would ultimately make it fairly difficult for the Fed to see 6 hikes. But I think March is still a certainty at this point.
And I think it's really interesting to see kind of what's happening in the equity markets as well. Thursday, when everything kind of with Ukraine and Russia first started, as far as the aggression is concerned, it was interesting. Futures were down considerably. It seemed like a day that would be risk off, meaning people would not want to own equities. And then you saw this huge swing in the NASDAQ and kind of the growthier stocks. In fact, they had a 6% intraday swing, which is huge. And so earlier this year, the growth stocks were really out of favor as we went into an environment where it was an expectation at one point in the market that there was going to be 7 interest rate hikes during the year. And basically the present value of a dollar of a future, the dollar of a dollar earned in the future would be less today, making growth stocks less attractive. Growth had really come down significantly. And I think the average small cap stock just in January was down about 29%. And then in Thursday, you saw this big swing where the NASDAQ was down considerably and then ended up. And you're seeing a continuation of that today. And basically, it's telling us the economy is slowing. The Fed is most likely not going to have to raise as quickly as what the expectations were in January. But as Scott mentioned, we are going to have these near-term inflationary pressures, which are even more severe than they were before. And so there is this balancing act again, talking about rotation, it is fascinating to see like alternative energy as well as energy are rallying today. So there's a lot of underneath the market, there's a lot of violent trends that are occurring.
You know, one other note on the energy, I was reading that Germany is likely going to be building 2 large LNG import facilities in response to this. So I think you're going to see Europe perhaps have a bit of a realization that they need to be less dependent on Russia, certainly for their natural gas, and this could lead to a pretty broad, a very large cycle of investment within both renewables and some of the more traditional energy sources such as LNG.
Yeah, I agree. I mean, I think you're definitely going to see that. And then the other big announcement from Germany, which was interesting, was the $100 billion announcement relating to defense spending, which is 2% of their GDP. So I think renewed spending around defense is obviously something that we'll particularly see in Europe.
Thank you so much, Scott and Leah. Super helpful. So let's dig a little deeper into this. What do you think is the likelihood of this conflict escalating into other parts of the globe? What about other former Soviet Union countries? Or more importantly, do you think it will empower China to look at Taiwan?
Yeah, so to me, this was the immediate concern when this conflict escalated. And I think the good news, as we've all seen and probably been inspired over the weekend, seeing the Ukrainians really push back and see Russia lose their momentum. And this conflict has been a lot harder for Putin than what I think he originally expected, and see the world kind of rallying around Ukraine. I think that's a positive for um, at least not seeing further aggression near term. I also think seeing the response of Europe is great from the China Taiwan situation, because China still a third of their exports go to Europe, and China is definitely a country that is more and more dependent on fiscal stimulus and has a significant debt issue. So if you look at the amount of debt that's been created globally since the financial crisis in 2008, 2/3 of that debt has been incurred by China. So it's not it's a huge economy, and one of the largest economies, obviously, in the world. But the dependency on Europe is an issue, and I think that kind of serves as a check and is less of more of a reason to be less concerned about that escalating. But I would not have thought that 5 days ago. I think the pendulum's really swung.
Yeah, I think the united front being shown between on the West with regards to the sanctions and the responses has certainly will certainly make China, I think more than twice about doing anything further. I would say that perhaps this news from Germany, and I know we've had a number of other countries who are supplying some ammunition and different things into Ukraine. I guess this does have the potential to end up with a bit of a what you might think of like a proxy war situation between the West and Russia taking place within Ukraine. But I don't know, I don't have a sense of the likelihood of it spreading to other Soviet nations besides Belarus, who is effectively a part of Russia at this point, I think.
Thank you so much. And just to follow up on that, Scott, how do you think, because credit market is something that we like to keep an eye out to look at the health of the credit market. So how do you think the credit markets are responding, and are you seeing any signs of stress there?
Right. Yeah. There was some concern over the weekend that with the SWIFT ban taking place with regards to the major Russian banks, that we were going to see some real funding stress when the markets opened. And there were even some analysts out saying that they thought that the Fed and other central banks might be required to inject dollar liquidity into the market. So, if some of these Russian banks, there might be missed payments, there might be overdrafts. The plumbing of the money market system is difficult to anticipate exactly what the knock-on effects are going to be. That said, this morning we have seen a move wider in what a common market variable to look at, which is the LIBOR OIS spread, which this has moved up, but it's still well below prior periods of stress. And really what this is this is a measure of the difference between secured and unsecured lending. So it essentially tells us how nervous banks are about lending to each other. And we've seen this rise a little, but not much. Some of the other things we look at, one would just be credit market spreads. So the spread that a corporation is required to pay above treasuries in order to issue bonds. This has risen. It hasn't risen a whole lot. So investment grade spreads are around 125 basis points. We came into the year around 90 basis points. And really most of that rise took place in January and early February, kind of alongside some of the other just sell-offs and other risk markets. So the direct response as far as Russia, Ukraine, we are not seeing it too much yet in the credit markets. We are seeing that companies are delaying issuing new bonds. So in the investment grade market, you'll have anywhere from 3 to 10 companies a day who come and issue bonds. It's not uncommon to have 20+ billion bonds issued. We haven't had any in a few days, ever since the Russia-Ukraine started, and this is all due to volatility in the markets and companies just saying, okay, I'm just going to step back and take a little break and wait for things to calm down. If we were to see this continue for an extended amount of time, that would be concerning. Now, that said, especially investment grade companies really increased the amount of cash on their balance sheet throughout the pandemic. Really took place in 2020, but the cash levels remain elevated. So there aren't too many issuers that are out there that I'm concerned about needing immediate access to the credit markets. But that said, so there's a few things that are kind of flashing yellow. Nothing that's flashing red as far as a stress indicator at the moment.
I think it's going to be really interesting to watch what happens with the crypto markets. So Russians, depending on what source you want to look at, own between 30 and 50% of crypto globally. And so it'll be interesting to see if you see more people piling into crypto because of the SWIFT and some of the sanctions, or if they are going to be liquidating because they need the liquidity. So I think it's going to be really interesting to see what happens there. And this is really the first conflict, or kind of, and I don't want to call it a test, but it's the first situation that you've been able to see some interesting dynamics happening in that part of the market.
Thank you so much, Leah and Scott. These are all the questions I had today. Thank you, everybody, for joining us. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Bye-bye.